Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 145 on December 19th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Electrameccanica Vehicles Corp, Pfizer, and United Airlines, and then we discuss three new trades on Fuelcell Energy, Freeport McMoran, and the VanEck Gold Miners ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, this week, the U.S. equity markets ticked a bit higher. The Dow Jones Industrial Average gained 132 points, ending the week at 30,179 points. The S&P 500 index picked up nearly 46 points, closing the week at 3,709 points. So we are still at all-time highs in both equity indices. And now it's time to discuss the topic of the week. And the topic this week is all about a little more conservative strategy than what's normally showed on the show. So we're going to discuss using in-the-money spreads to earn 5 to 10% return monthly. Now, each week we discuss these debit spreads that are in the money. And for the sake of the show, I typically am focused on higher return opportunities. I love looking at trades that allow you to earn 50% or more on your capital in a few weeks. And those are insane returns, right? It's not normal to earn that much money in a month. As far as the return is concerned, but you can use that same strategy in a more conservative way. And there are opportunities with blue chip companies that can still lead to great gains, but they're going to be closer to 5 to 10% in a month. So consider Johnson & Johnson. I don't have many opportunities to present trades on the show on that company because it typically runs at a lower volatility, meaning it doesn't have the kind of fast or frequent price movement that other companies have. And, this is also like an old school dividend paying stock. Now, if you were to pay the current offer to buy the January 145-150 call spread, you would pay $4.40 for a $5 spread, or in real terms, that's $440 for a spread that's going to be valued at $500. That's an 88%. That's 88% of spread value. And with Johnson & Johnson trading at $154.51 right now, this spread is $4.50 in the money. Now, as long as the stock stays above $150 per share, this spread will expire worth $5, allowing you to earn 12% on your capital in 4 weeks with a blue chip, low volatility, dividend paying stock. This is the value of understanding options. When you understand options trading, you can find opportunities in the market that match your risk level and try to craft strategies that can pay you oversized returns. So several of you have already reached out about the upcoming option trading class and have signed up, which is great. It will consist of video training, and that's ultimately 36 videos to take you from the basics of option trading all the way to handling more complex spreads and strategies. Then there will be weekly live webinars during the month of January, and those are going to start on January the 6th. We will discuss and make live trades on the weekly webinars. So the goal is for you to earn the cost of the class back in the markets, like in trading, during the time period that the class is going. And either way, I'm certain you will earn much more than the price of the class over the course of the year and over your lifetime. Education is truly the gift that keeps on giving, and that's why I'm big on education on this show. So email me at eric@theweeklyoption.com for more details about the class. Now, let's talk about the trade results from last week. We're going to start off with that covered call. We looked at Electrameccanica Vehicles Corporation, symbol SOLO, S as in Sierra, O as in Oscar, L as in Lima, O as in Oscar. At the time, the stock was trading for $6.44 per share. I looked at buying stock and selling the January 7 call at $1.10, which can give us a maximum return of 25.78% in 5 weeks. Well, Solo stock gained 85 cents per share, closing the week at $7.29. The call option we sold could be bought back for a loss of 15 cents, yielding a net gain on the trade at this point of 70 cents. Now, if you were to, that's only if you were to close the trade right now. If stock expires in 4 weeks above $7 per share, the trade will have a net profit of $1.66. That's the profit of 25.78% if this option expires in the money. So I would definitely advise against making any adjustments to the trade or even closing the trade to take the 70 cents profit. For me personally, making 70 cents when I could have made $1.66 is just painful, right? So this one worked out as planned, so no adjustments needed. The next trade we looked at was a credit spread on Pfizer, symbol P as in Papa, F as in Foxtrot, E as in Echo. At the time, the stock was trading for $41.12 per share. I looked at selling the January 40.39 put spread at 40 cents, and that can give us a maximum possible loss of 60 cents per spread. Now, shares of Pfizer fell $3.44 per share this week. The out-of-the-money put spread we sold is deeply in the money at this point, and the spread is valued close to its max value. At this point, I would not buy it in. I'd rather wait to see if the stock will head higher again, which is not unlikely. There are two things I would consider based on price movement over the next 2 weeks. So first, if the price continues to fall, I would consider selling a call spread. I would typically prefer selling a call spread with a strike at or above the original spread strike. In this case, we can sell the January 40.41 call spread and collect 16 cents. That's not particularly enticing at this point. So as you would have to sell 3 spreads to offset the loss from the past week. Do not do that. Our goal, of course, is to reduce risk and lock in profits. So selling 3 of the call spread will greatly increase your risk. The other thing I would look to do on this trade is, if prices moved higher, is to sell another put spread. Now, with much lower strikes. So with 4 weeks left until expiration, there's still plenty of time to figure out what we're going to do on this trade and to even see if our original trade is going to work. We've almost already assumed our full possible loss. So everything from here is upside unless you multiply your risk. Don't do that by selling more spreads at a higher volume. So the reason a lot of times you guys will hear me, the reason I'm not worried, I don't worry on these spreads is because, I always price these spreads so that I can handle the risk of loss, right? I'm never betting the farm, so to speak, on these trades. So sure, Pfizer went against us, but because I understand risk and I size the trade appropriately before I enter it, I'm not that concerned about this loss, and it allows me to take emotion out and be able to think rationally on what my next step will be. And that's something that is always going to help you, because it sucks to lose money, but if you've got $500 in your pocket and and a $5 bill falls out of your pocket, sure, you're going to be mad. But imagine if 400 or 500 fell out of your pocket, then you're done for the day. So that's the way I trade. I trade knowing that I can lose a little bit of money, and if I lose that little bit of money, I can think rationally about ways to go ahead and earn it back. And our final trade from last week was on United Airlines, and this one also is going to be a bit of a dinger, which upsets me a little bit, but not to the point where I'm emotional. So United Airlines, symbol UAL, U as in uniform, A as in alpha, L as in Lima. The stock at the time was $48.36. We looked at buying the January 47.48 call spread for 65 cents, hoping for a maximum gain of 35 cents or a 53.85% return in 5 weeks. Well, United Airlines stock fell $3.62, closing at $44.74 per share. And to be honest, when I was looking at the chart last week, it looked like it was pulling a little bit higher. Maybe the vaccine was leading people to go ahead and buy more airline shares. Maybe travel was going to open up. And then you look at the chart again this week, and it's like, man, what did I actually see? Because it looks like we're continuing on in a bearish trend. Now, the in-the-money call spread we bought is now, of course, out of the money. It can be sold at 24 cents, which will lock in a loss of 41 cents per spread. We can sell the January 49.50 call spread at 17 cents, which lowers our loss to 24 cents. I actually would not sell an iron condor given the clear strength of the downward price trend in this stock. What I initially thought, of course, was going to be a counter trend or a pullback, just proved simply to be a continuation of the previous lower trend. So some guys are breakout traders, counter traders, contrarian traders. Others are trend traders, and I'm definitely a trend trader. So definitely going to be avoiding trades of this nature in the future, hopefully. Now, let's get into the trades for this week, which I like more. And of course, yesterday, Friday, December 18th, was options expiration for December. So what that means is that all of your options with a December expiration are either priced at their intrinsic value or they are valued at zero. They're worthless at this point. And then for this upcoming week, the prices that I give on this show for these three next trades are going to obviously be different when the market opens on Monday, but typically the interim, the like 50-cent strikes will be priced. So you might actually find a better opportunity on these same names. So definitely pull out the paper and pencil and make sure that you get the best deal for your capital. All right. So we'll start off with the covered call. Looking at Fuelcell Energy, symbol FCEL, F as in Foxtrot, C as in Charlie, E as in Echo, L as in Lima. The stock ended the week at $9.30 per share. I'm looking at buying that stock and selling the January 10 call at $1.30, which could give us a maximum return of 21.5% in 4 weeks. Now you enter this trade by paying $9.30 for FCEL stock and selling the January 10 call at $1.30. This trade makes the most money if stock prices finish above $10 per share, and the break-even price on this trade is $8 per share. Now, in real terms, the stock purchase would require $930, and you would collect $130 for selling the option. Next trade on the week is a credit spread. Looking at Freeport McMoran, we've looked at the stock before. Symbol is FCX, F as in Foxtrot, C as in Charlie, X as in X-ray. The stock ended the week at $24.63 per share. I'm looking at just selling the January 24-23 put spread at 34 cents, which can give us a maximum possible loss of 66 cents per spread. Now you enter this trade by selling the January 24 put at $1.01 and concurrently buying the January 23 put for 67 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $24 per share. The break-even price on this trade is $23.66. And in real terms, you'll receive $34 per spread that you sell and have $66 at risk. And then our final trade on the week is a debit spread. Looking at the VanEck Gold Miners ETF, symbol GDX, G as in golf, D as in Delta, X as in X-ray. Stock ended the week at $36.58 per share. And I'm looking at buying the January 35-36 call spread for 68 cents, which could give us a maximum return of 32 cents, which is a 47% return on your capital in 4 weeks. And you enter this trade by buying the January 35 call for $2.48 and concurrently selling the January 36 call at $1.80. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $36 per share. The break-even price on this trade is $35.68. And in real terms, you will pay $68 to enter the spread, and your maximum gain is $32 per spread. So that's it for the show for this week. And let's see. Next week, I will create a show on Saturday again. Of course, Friday is going to be Christmas. So for those of you that are celebrating Christmas, have a Merry Christmas. And I look forward to you joining me next week for our post-holiday show. And thank you guys so much for listening. Thank you for sharing the podcast too. I've been amazed at the growth of listeners this year, and that's all because you guys have been sharing it. So thank you very much. Thank you for listening. And as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.